All right, class, settle in and welcome. Today, we're really going to pull back the curtain on accounting. We're going to explore the foundational principles. You can think of them as the unspoken rules that make this entire field work. And I don't want you to think of these as just some dry, boring regulations. No, think of them as the very grammar of the language of business. And believe me, understanding this grammar is the absolute first step to becoming fluent. So let's kick things off with a big question. Every discipline, every sport, heck, every language has a set of rules. Some of them are written down, right? They're explicit. But so many of them are just implicit. They're just understood. Well, business is exactly the same. For accounting to work on a global scale, there has to be a shared understanding. So, what are these invisible rules that let everyone, everywhere, understand this language of business?
And the answer to that question, it lies in a shared set of foundational assumptions. Now, I want to be really clear about this. These are not just helpful suggestions or, best practices. They are the absolute bedrock of all financial reporting. They are what ensures that when a manager in one country and an investor in another country and the company itself all look at the same financial report, they are all playing the same game. And more importantly, they can all trust the numbers they are looking at.
So here is our game plan for today. First, we're going to frame this whole language of business idea a little more formally. Then, we're going to do a deep dive into 3 of the core assumptions. And to help you remember them, I've given them some nicknames: the money rule, the separate worlds rule, and the long game. Don't worry, we'll cover the proper names for each one too, of course. And finally, we'll wrap it all up and really understand why these rules are just so critical for the entire global economy.
Okay, let's get into it. Our very first core assumption is the one I call the money rule. Now, its formal name, and this is one you are absolutely going to want to know for your exams, is the monetary unit assumption. This whole principle answers a really basic question. What's the yardstick? What do we use to measure everything that happens inside a business? The formal definition here is absolutely crucial. It says that all transactions have to be recorded in a stable currency. That word stable is doing a lot of heavy lifting here. You see, this assumption is really just a practical simplification. It lets accountants ignore, at least for the main financial statements, all the messy, complicated stuff like inflation or the day-to-day jumps and dips in a currency's value. We just pick one unit of measure, like the US dollar, and we decide to treat it like a stable anchor.
Okay, so let's see what this looks like in the real world. The first point here is pretty straightforward, right? A business in the US uses US dollars. Easy. But let's really focus on that second example, because this is where students tend to get tripped up. Imagine a company buys a piece of land for $50,000 way back in 1990. Today, that land might be worth $1 million. So, what value do we put on the balance sheet? Well, under the monetary unit assumption and its partner, the historical cost principle, it's still listed at $50,000. Now, you might be thinking, why on earth would we do that? And the logic is all about being objective and verifiable. That $50,000 price tag is a cold, hard fact. We have a contract, we have a canceled check. That $1 million value today, that's an opinion. It's an estimate. And accounting, at its core, will almost always prioritize verifiable facts over subjective opinions. That's what gives us a consistent record over time.
All right, let's move on to our second foundational assumption. This is the one I call separate worlds, but its proper name is the economic entity assumption. So if the first rule was about what we use to measure, this one is all about who or what we're actually measuring. It's about drawing a really clear, bright line in the sand to define the exact boundaries of the business we're looking at. The key concept here, the word you need to remember, is separation. For accounting purposes, we treat a business as its own distinct person. Its financial life is totally and completely separate from the personal finances of its owner, its managers, its employees. Just think of them as 2 separate economic worlds, and the absolute #1 rule is you can never, ever cross the streams. This little table here illustrates the idea perfectly. Over on the left, you've got the coffee shop's economic activities: buying coffee beans, paying wages, making payments on a business loan. That stuff belongs on the company's books. But on the right, you have the owner's personal life: paying their mortgage, buying groceries for their family. So what happens if the owner takes money out of the business account to pay for their personal car? Do we record it as a car expense for the business? No way. It gets recorded as a withdrawal or a draw by the owner. That boundary has to stay intact.
And this leads us to a really critical question. What happens if you break this rule? What are the consequences?
I can tell you, without a doubt, this is one of the most common mistakes I see new entrepreneurs make. They use the business credit card for personal dinners, or they pay a business supplier from their personal bank account. They think, what's the big deal? It's all my money anyway. The big deal is that you end up with a completely distorted and frankly useless picture of how your company is actually performing. You can't make good, data-driven decisions anymore because your data is totally corrupted. You have no idea if the business is actually profitable on its own, or if it's just being propped up or maybe even drained by the owner's personal finances.
All right, let's move to our third and final core assumption for today. I call this one the long game. The formal term for it is the going concern assumption. And this principle is all about time. It's about perspective. It forces us to look toward the future, and it fundamentally changes how we value everything a company owns and owes.
The definition here is pretty simple, and it's quite elegant, really. We assume the business is going to continue operating indefinitely, or at the very least, for the foreseeable future. We don't sit down to prepare financial statements assuming the company is about to go bankrupt and sell everything off next week. It's a fundamental assumption of stability and longevity. We do the accounting for a going concern.
So, why is this so critical for making decisions? Well, let's think about a practical example. This assumption is what lets a company buy a factory for $10 million and then spread that cost out as an expense over its useful life, let's say 30 years. You know that process? It's called depreciation. We can only do that because we assume the factory will be operating for those 30 years. It's the exact same logic that justifies having a 30-year mortgage on the books. We assume the company will be around long enough to actually pay it off. Now, imagine if we threw out the going concern assumption. The entire logic of the balance sheet would just collapse. We'd be forced to value every single asset at its immediate liquidation price, its fire sale price. You know, what we could get for it if we had to sell it tomorrow. And that would paint a completely different and usually a much bleaker financial picture.
So, let's bring this all home. Let's tie it all together. We've just walked through 3 rules that might seem a little abstract, maybe a bit academic, but I hope you're starting to see that they are anything but. They are the absolute foundation of financial trust. They are the essential pillars that hold up all meaningful financial analysis.
Here's the most crucial takeaway for today. Without this shared understanding, financial reporting would just be pure chaos. Every company's financial statements would be this unique, incomparable mess, but because we have these assumptions, we create a universal standard. And that standard is what allows an investor to confidently compare the financial health of a tech giant like Apple to that of Google, or even your local coffee shop to a massive chain like Starbucks. They are all speaking the same financial language because they are all following the same rules of grammar.
And you know, there's a really beautiful inherent logic to how these assumptions all build on one another. You can see it right here. It's a 3-step process. First, the monetary unit assumption gives us a stable yardstick to measure with. Second, the economic entity assumption draws clear boundaries around the thing we are measuring. And third, the going concern assumption gives us a long-term perspective for how we value it all. Measure, define, and project. It is such a powerful and logical sequence, and it's the very foundation of trust in our financial system.
I think this quote just captures the essence of what we've been talking about perfectly. These assumptions really are the silent agreement. They are the fundamental grammar that provides structure and meaning. Without that grammar, a set of financial statements is just a meaningless jumble of numbers. But with it, those same numbers are transformed into a powerful story about a business's performance and its position, a story that we can all use to make incredibly important economic decisions.
And that brings us to our final thought for today. As you all continue your studies in business and accounting, I want to leave you with a question to chew on. These rules, they were developed in a very different era, and they've served us incredibly well for over a century. But what are their limitations in our modern, crazy, rapidly changing world? How does that stable currency rule hold up when companies start using volatile cryptocurrencies like Bitcoin? How does the going concern assumption really apply to a tech startup whose entire business model might be to get bought out or fail within just a couple of years? Now, these are not easy questions, but they are exactly the kinds of questions that are going to shape the future of accounting, and I encourage you all to think about them. All right, thank you.